Hello, and thank you for joining us today for Trilogy's quarterly market commentary. Whether this is your first time joining or you're a regular attendee, welcome. We're glad to have you here. I'm Caitlin Spain, Trilogy's Product Operations Manager, located in our Denver, Colorado office, alongside our Chief Investment Officer, Mike Serio, who we will be hearing from today. For the next 45-ish minutes, Mike is going to share some economic perspectives and market insights, and he will help us connect the dots from the past, shed some light on what's going on right now, and help us navigate what's ahead. If you have any questions during today's call, you can email investment.team@trilogyfs.com, and we'll do our best to address those at the end when we do the Q&A session. Before I turn it over to Mike, let me tell you a little bit about him. Mike Serio is the Chief Investment Officer at Trilogy Capital. He's responsible for investment strategy and client communications, and he oversees $4 billion in client assets. He has over 30 years of Wall Street experience as a portfolio manager, strategist, and chief investment officer. And he's been frequently quoted in the Wall Street Journal, the New York Times, Bloomberg, the Washington Post, and other publications. He worked on the Russian project for the United States Agency for International Development in the formation of capital markets in the former Soviet Union. He's a former adjunct professor at the University of Denver and DePaul University. He earned a bachelor's degree in economics from the University of Illinois, an MBA in finance from DePaul University, and he is a CFA, a chartered financial analyst, as well as a CAIA, a chartered alternative investment analyst. So, such credentials, Mike. We're really looking forward to what you have in store for us today. And with that, the floor is yours.
Great. Thank you, Caitlin. I know that was a mouthful. So, what do we want to talk about today? And there's certainly a lot of things going on there. So, today, I'm going to try to get this in about a half hour, 40 minutes, and then we're going to take questions or your comments. And as Caitlin said, here is the email you can do. It's investment.team@trilogyfs.com. She will be taking emails, and then we'll be getting to those towards the end. As usual, we're going to start off with macro comments, meaning what's going on in the economy. What are the couple most important things we have to be aware of? We're going to talk a little bit about market valuation, which is on a lot of people's minds. We're going to talk about timing the market and how difficult that can be, especially using valuations. We've taken some recent tactical positions in those types of portfolios, looking to take advantage of some inefficiencies out there and some ways to find what's growing and where our clients should be. And then I'm going to end up before questions with the importance of rebalancing, and how that is one of the few free lunches in the financial markets. But first, let's get to those macro comments. And we always want to look at the consumer, because the consumer is about 70% of our economy, give or take, and their spending is extremely important to not just the United States, but the world, because as always says, when the U.S. consumer sneezes, the world's economy catches a cold. So if you can take a look at that blue line down there and way on the bottom right, you can take a look at what the household debt service looks like. It's not necessarily the amount of debt consumers have on, but it's what percentage of their debt is going to, of their income is going to pay off debt. And you can see this chart goes back to 2005, and it looks pretty good right now. Although there's a bit of a bifurcation in the consumers being the top half versus the bottom half, it looks like the top half is doing well, partly because financial assets are doing well. The bottom half is struggling a little bit, and that is one small concern we do have right now for the economy. Another thing that's going on is we are in a Fed rate cut cycle right now. And we went back and looked at what happens when the Fed starts cutting interest rates. Usually that's pretty good for the economy. Companies have the ability then to borrow more. Money's cheaper, then they can go out and hire. Their projects are that much more profitable. What's also important is when interest rates come down is people are able to afford houses. And that's always good because for those of us who have moved a number of times, you spend a lot of money when you move at Target and at Home Depot at all, but it has less to do with the Fed rate cuts and more to do if the Fed times this correctly and we don't go into a recession. So the top four right there, starting in 84 and going to 2019, looks at the market 12 months after that Fed cutting cycle, and you can see markets have done quite well. Um, it's not just good for spending, but it's good for what we call the present value of future cash flows, and those get more valuable when you look at a market. And so it's truly the question is, are we going to go into a recession or not? Because when you look at the other two instances, 2001, 2007, it was less about Fed rate cutting and more about bad things that happened after that. You know, remember in 2001, we had a number of different things. We had the internet bubble pop. We had 9/11, we had a recession, and we had a war. And then 2007 was certainly something a lot of us remember. That was the beginning of the great financial crisis. If you look on the right side, those are 10-year returns after. So it looks like, again, it depends on the economy and less on what the Fed does. Another issue I want to tackle here is international investing. And if you look at back to 2000, there has been about 4 years where international has done better than the U.S. Markets. Partly for that is the movement of the dollar, but it's mostly about the growth rate of all these different countries. So I got this out of The Economist just recently, and this looked at the growth rate, which is given in the different lines, the United States being the red line. And you can see the growth rate in the United States has been much higher than that of what we call developed market countries. And these are Western European countries plus Japan. It's been much higher in the United States. And part of that is due to our technological advances here. And it's much easier to open a tech company here because remember, for every Google you had, there was an Ask Jeeves, there was a Netscape, and so forth. And when you look at what happens in the United States as we build companies up, there's a number of competitors, a couple good ones make it, and then the other ones, those resources, mainly people, get redeployed into other areas. And you can't do that easy. And certainly in Western Europe and Japan, laying people off is very, very difficult. The other thing people are worried about are tariffs. And what we did here is we looked at sales growth, less change in cost growth. So you would think that cost growth, because of the tariffs, if the companies were absorbing those tariffs, would be much higher than sales growth. But what we're seeing right now is sales growth uh, rising at a 2% greater pace than cost growth. So that's been really good for our markets. Again, you look at what the market has done this year, the US market's up 12.4% as of the close of business on Friday. It's been a tremendous year. And, you know, on top of what we did last year with up 24%, investors, especially those equity type investors, have garnered some very attractive returns over the past year and a half. So then you have to ask, and I've gotten this question many times, is how long can this last? And we always say that certainly history doesn't repeat itself, but it certainly rhymes. So if we go back all the way to 1928 and look at all the bull markets present out there, you can see the duration is on the bottom or the x-axis. The returns is on the y-axis or the vertical axis, and you can see all these different bull markets. And the average lasts about 59 months, and that's up 178%. Here's where we are today, right now. This one started 10, 12, 22. Although there's some arguments there because we did get a mini bear market in there, an intraday bear market, but technically, no, we didn't close on a bear market. And you can see we are only 34 months into this, and we're up 81%. So if we compare this to historical norms, we certainly have a long way to go. Now, another question we're getting, and if you looked on 60 Minutes last night, Andrew Ross Sorkin, who I watch every day on CNBC, is coming out with a new book, and it's coming out tomorrow, talking about bubbles and bear markets and so forth. And his thesis was valuations. It's so overvalued. You know, this thing is due. let's hold on a second and take a look at valuations and how predictive they are for 1 year returns going forwards. And if you look at valuations today, they're pretty elevated by any means, price earnings ratio and so forth. But I will tell you that historically, valuation has been a poor timing tool for markets, much better for individual investments. So if you look at one way to value a market, it's called the Shiller Index. It's inflation adjusted earnings and forward 1 year expected returns. And this is really interesting because if you're ever taken statistics, you'll know that correlations are very important. A pure correlation or a correlation of one signifies perfect correlation. What this chart is showing us going all the way back to 1950 is that valuations are very uncorrelated with stock market returns going forward. And you can see what we call an R squared. It's only 0.06 are explained by valuation. So the conclusion here is that 1 year going forward, valuations don't really predict stock market forward returns. If you look at it on a 10-year basis, it gets a little better. That it used to be about 0.7. It's gone down in the past 15 years to about 0.58. A couple of these things going on is our index, and I'll talk about the makeup of our index in just a second, makes it very different. But again, if you're looking at forward 10-year returns, you can see you have to have some very, very high valuations towards the right of the chart to actually have flat or negative returns. But otherwise, there's somewhat of a correlation of 0.58. Now let's get to how the market is valued right now and talk about the makeup of the index we used to use for value. You can see one way to value this market is the New York Stock Exchange and the NASDAQ market capitalization as a percent of what we call nominal GDP. This is GDP not adjusted for inflation. And you can see certainly pretty high right now. But I'll put it to people that there's two regimes or eras here. The first one for the chart would be 1950 to call it 1995, where valuations certainly were much lower. And the reason for that is there's not an industrial revolution going on like there has been here. So valuations for stocks that weren't growing that fast are certainly going to be very low. On top of that, bond yields from the 50s, 60s, 70s, and 80s were much higher and much more competitive with equities than they are right now. The second era started in and about 1995 with the advent of the internet and a company, if we remember that, Netscape going public. Netscape didn't have any earnings, neither did it have sales, but it was one of the few pure plays on the internet. And that was that first industrial revolution of this century in the late 90s, 2000s of the advent of the internet. And it made the productivity of our economy that much higher. So you'll see that certainly if we started this chart in and around 2000, it would look much different. So you look at the far right, that's the weight of the top 10 stocks in the S&P 500. You'll see those 10 stocks now comprise about 39.5% of that weight. So it's a much different index right now than it had been going way back to the 50s. And I'm sure everybody here has heard of the Magnificent Seven. Those are the top 7 growing stocks in the United States, including NVIDIA, Microsoft, Apple, et al. Right there on the right. And these are companies that are growing their earnings 18, 20, 22% a year. And they certainly do warrant premium valuations versus slower moving companies than such as a utility or a consumer non-durable. And so I would put it to people that, again, this index, it's very hard to compare this index versus what it was, back before the year 1995. Okay, let's go through some of our tactical shifts and some of the interesting areas we're finding value and opportunity in the markets. The first one, which is something we did, we're going to talk about in a second, called the introduction of active small and mid-cap value stocks. In our fixed income portfolios, we've moved from more of a passive or index type of investment to active core and unconstrained fixed income. We think going forward, there's going to be some great opportunities for active fixed income. We rebalanced, and I'll talk how important that is, our Freedom, Target, Tactical, and Tactical Plus portfolios. And some of our tactical shifts include consumer discretionary. Other positions include artificial intelligence, power generation, what we call cash flow aristocrats, and deglobalization. And within our U.S. equity portfolios, we're overweighted in communications, utilities, and financials. So let's talk about some of these tactical shifts we've undergone in our portfolios. Here's a good chart by JP Morgan. It's kind of busy, but let's look on the far right side. It looks at large cap stocks, mid cap stocks, and small cap stocks. And I want to point out, I'm usually a positive person, but here's the percent unprofitable in each of those areas. And if we look closely, only 7% of large cap stocks are unprofitable. But if we go to mid cap stocks, 17% of those are unprofitable. And in small cap stocks, almost half are unprofitable and not making money. And I have to ask, if you're not making money now, we've had a long expansion here post-COVID. When are you going to make money? Certainly a lot of those stocks could be biotech stocks or tech stocks that really haven't made it quite yet. But as a group, there's a lot of unprofitable companies in those areas. But let's take a look going forward, what the market thinks they're going to earn. So the blue lines here are the S&P 500. As I said, those are dominated by those 10 stocks and other large stocks. And then you look and compare that versus the S&P 600, which is a much smaller index. When I say smaller companies account for a lot more in the 600 than they do in the 500. So you can see first quarter 26 and on, the market thinks that the growth rate of earnings for those smaller stocks actually look pretty attractive. So our investment committee and myself, we've been researching this for a long time. We thought, boy, that would be a good place to be. But you've got to be really careful on what you buy there. So we've switched from a passive approach to mid and small cap stocks, which we call SMID, into an active approach. And we've hired some really good managers there that have the ability to look at value and to look at actually which companies are going to be making profit. Okay, another tactical shift is we actually think next year there's going to be a consumption wave. The first big input into this shift is depends on federal tax refunds. As we all know, the Tax Reform Act has been extended. Their withholding tax is much higher right now than there should be. So if you take a look at estimated tax refunds coming in and around that first quarter, certainly depending on when you file your taxes, could be near an all-time high at $517 billion back in consumers' hands. And as I've mentioned before, 70% of our economy is consumer spending. What we do know is that when people do get tax refunds, they certainly will spend those rather than save those, and that's really good for the economy. Other factors in the consumption wave there's World Cup happening here next year. I know tickets are already expensive and hard to get. So there's going to be an influx of tourists in this country, which is always good. There's the 205th anniversary of the United States. We still have a lot of revenge travel left over from COVID. If you've been abroad and try to get into the Sistine Chapel or the Eiffel Tower, that's a tough ticket right now because of a lot of people did not travel for a number of years during and after COVID. But this also assumes no recession, and we only put the probability of a recession next year anywhere from only 15 to 20% or so, given what we know now. Next one we want to talk about are those cash flow aristocrats. These are companies that don't have to access the financial markets to grow their businesses. Think of companies like Apple, think of companies like Amazon. They're generating a tremendous amount of capital coming into their company. So we look at the return on their capital. They have the ability to pay labor more, and this is really important in this AI-driven economy we're in because AI engineers, I don't know if you have a child or a cousin or a nephew or something that's an AI engineer. These people are making a lot of money, and there's a lot of demand for people with that specialized talent. And they have the ability to hire more labor. So that's the return on capital. As investors, we want to certainly look at the return of capital. These are companies, because they have so much capital, they're going to be able to do share buybacks, retire debt, and pay a dividend, which historically are always good for stock prices. Let's get to the AI theory next. On the right chart, you can see the value of private manufacturing construction, what we call capital expenditures or CapEx. And you can see that the main buyers of CapEx are chemical, computer, transportation, and then the ubiquitous other. But it's gone through the roof on computer, electronic, and electrical investment in their companies. So the $64,000 question is this capital, this CapEx going to pay off in productivity somewhere down the line? And I think if there's a way for this market to stumble within a couple years, we'll know is all this money they're putting into property, plant, and equipment, into chips, into power generation, if it in fact is going to pay off. And we certainly won't know for another couple years. You know, it's kind of funny. I looked at the timeline of artificial intelligence. You can see that it actually has been around for quite a bit. 95 to 2001, that's when we went into the connectivity and commerce. That's where we got, again, those great companies coming out of the late 90s, the Amazons, the Apples et al. Those are doing very well. 06 to 2017, this was the beginning of mobile computing. You know, there's more computing power on your phone right now than there was to send the rocket to the moon in the 60s. Then we went to 2013 and 24 content wars. Content wars. That's where we got great companies like Netflix et al. 2022 to 2025, we got things called large language models and computer capacity, CapEx. This is why the NVIDIAs of the world are doing so well. Companies are expending a lot of capital for those. And then going forward, we actually think this is going to be the era of agentic productivity. And I had to look this up. This is when your computer is going to autonomously complete tasks, streamline workflows, and make decisions to solve problems, which is certainly going to be a boom for productivity in our country. It doesn't come without a cost, though, and another area we're putting money into is power generation. As I said before on these calls, a ChatGPT search uses about 10 times the amount of power as does a Google search. So certainly electricity generation is going to be very important. We're going to have to spend a lot of money on transportation, especially with the advent of electronic vehicles. These places get very hot. We're going to have to spend money to maintain temperature, manufacture goods. Just recently, last week, we've learned how important excavating raw materials and fertilizer are. You're not going to go anywhere without the rare earths that are going to be needed. And certainly a lot of plant and harvest and purifying and pumping water are going to be needed for going forward with AI. Another one, and our last one I want to talk about, is the deglobalization of the world economy. In the 80s and the 90s, it was always given that capital moved to where labor was cheapest. And at that time, the cheapest labor was in China and the Far East. So companies would take their property, plant, and equipment, move it to China. It was easier to make things in China and ship it to the U.S. and sell them at the U.S. As we can see, the price of TVs versus what it was in 1980, TVs are almost free compared to what we paid for a TV in 1980, and obviously the quality of the TVs, there's no comparison. But you can see those lines have flattened out and started to move down. So we're looking to take overweights, which we have in industrial production, natural resource procurement, and energy security defense, which is very important, and those areas which are going to benefit from the deglobalization of the world economy. Caitlin, let me finish up here with something that's extremely important, and we've been going through over the last couple weeks, couple months, and that's what we call rebalancing. So way back when I took my first economics course at the University of Illinois, a very influential economist named Dr. Fred Gottheil was my professor, and he was a wonderful man. He passed away a number of years ago, but he wrote on the board, yes, back when we had boards, said, there is no such thing as an economic free lunch. Meaning to get something, you have to give up something. One of the things Milton Friedman once said is you can't find a $20 bill on the sidewalk because somebody would have picked it up already. That's economics. But in finance, there is one free lunch we do take advantage of, and that is called rebalancing. And let me explain this. You may have seen this chart. Some people call it a quilt chart. Other people with a chemistry background call it a periodic chart of the asset classes. What this does is it looks at each particular asset class we invest in. It could be REITs, it could be small cap stocks, it could be US large cap stocks, and each of these asset classes has a different color. This chart ranks them, and it goes back to 2010. We only have so much real estate on the chart. It could go back even farther, but the conclusions are the same. And each particular asset class has a color. And what we can see just looking at the colors, and we can conclude a couple things, is first of all, it's very random which asset class is going to be at the top each year. Again, these are ranked from best returning asset classes to worst. So you can see that the ones at the top, it's pretty random. And if we were really smart, but nobody's that smart to figure out which one's going to be at the top, we put all your money there. But since we don't know which one's going to be at the top, that's why we diversify. The second thing we've concluded is those are that spend time at the top, such as small cap right there in 2020, have a tendency to also spend time towards the bottom, as small cap did in 2022. So again, in essence, what we hear is we don't have much of a free lunch because this is telling us to get more return, we're going to have to take more risk. I also want to point out is if you look at the middle of the chart, those white squares, that's what we call asset allocation. So that's a hypothetical 60-40 portfolio, 60% stocks, 40% bonds. And at the end of each year, what happens is we sell the winners and we go into the losers. Okay, so it's always rebalanced January 1st at 60-40. Now, something really interesting happens right here because if you look at the far left columns, you'll see 2010 to 2024, which is the time frame of this chart. We rank returns and we rank volatility. So this is where the free lunch comes in. So you'll see this asset allocation portfolio of 60-40 ranks about near the top. Now, what we're getting is the next column is volatility or risk taken. What I find interesting is that asset allocation portfolio is more towards the bottom. So if you're a beer drinker, you'll see, less filling tastes great. In this case, more return, less risk. How does this happen? Well, part of it's just a little arithmetic. Okay, and this is an extreme example, but it brings out what the theory is. You have two asset classes. Those asset classes could be, again, small cap value, could be REITs, real estate, could be large cap growth at all. You have year one returns. Let's assume asset class one does 30%, and year two it does 0. That's obviously a total return of 30%, and that's some fairly high volatility. You've got asset class 2, which did 0% in year 1, 30% in year 2, has again a total return of 30%, with again some high volatility. So what if we took these two asset classes? Before that first year, we invested 50% in asset class one, 50% in two, and then we sold off our winners and bought our losers. And then we had that, what we call reversion to the mean or reversal. What you're going to get is 15% in year one, 15% in year two. Instead of getting 30%, we picked up a free, yes, free, 2.25% via rebalancing, and we had a much lower volatility. And again, if we go back to where we were on those far left columns, you'll see again, higher return, lower volatility in practice. This is theory. That's why we are doing this. And if you look at your statements, you'll see some transactions out there kind of backing off on stocks and going more into bonds as stocks have done quite well. The last reason we want to do that before we get to questions is this is a really good chart. Again, looking at a hypothetical portfolio set on January 1st at 19, again, 60% stocks and 40% bonds. What would happen if we didn't rebalance? Well, you can see that stock weighting goes up considerably. And at the end of, I think this is, yeah, at the end of 2024, the stock weighting has risen to 73% over those 6 years, which gives us a much different risk profile than that 60-40 stock portfolio. So we certainly have to be aware of risk return, but we also have to be aware that our clients in the beginning of 19 signed up for a 60-40 portfolio, and if it was static and nothing was done, they're going to be 5 years older in a much riskier situation than they signed up for. So it's very important to rebalance. So with saying this, let me kick it back to Caitlin, and let's have some questions or comments.
Wonderful. Thank you, Mike. Really appreciate your insights and sharing this content with us today. We've got some questions, and I want to remind everyone before we get started with the questions, if you do have any additional questions, feel free to email those in to investment.team@trilogyfs.com. I'm going to ask questions and I'll be looking at the inbox. So if anything comes through, we'll make sure that we take some time to address that as well. Mike, first question. I know that you are usually a positive person, and I also know that as a CIO, part of your job is to worry. So what kinds of things keep you up at night?
What kinds of things keep me up at night? Well, if you look at the markets today, one of the things that is an all-time high is gold. Now, gold is really interesting that you can't eat it. There aren't many industrial applications at $4,000 an ounce, and it's the only reason it's worth something is because people and the markets think it's worth something. So usually we see gold rise one of two different ways. First of all, it is generally considered an inflation hedge. So if you look at the bond market isn't worried about inflation now. So there's a big disconnect in the bond market. The second thing, it's usually a hedge against falling stock prices. And I'm like, interesting, going, well, we're at an all-time high. So why would we have so many, so there's a real disconnect right there. So that gets me a little worried now, like I'm not seeing something right there. The second is the amount of, speculation in the market right now. And if you look at the amount of levered ETFs, and these are extremely risky. We won't go into the specifics right now, but again, it's applying leverage to a very risky investment. Last time we saw this was, 13 years ago during the great financial crisis. We're having a number, 3, 4, 5, 6 a day come out, and that gets me a little worried. And then finally, the other thing that gets me worried, Caitlin, is there's a weakness in oil prices, and that usually comes from one or two reasons, is that companies and OPEC are oversupplying us with oil. So there's too much supply out there. That usually takes care of itself organically as they put down pumps. OPEC starts producing so much, or it's a comment on the demand side where if when the economy's slowing down, the demand for oil starts falling. And those are the three main things that worry me about things right now. And yes, I am an optimist, but you're always worried about something.
Absolutely. Talking about the gold thing, I mean, this is in the news, right? It's over
Hmm.
$4,000 an ounce.
Yep.
So it's crazy, frankly. So in terms of kind of this movement that we've seen, this sort of flight to gold, what are you thinking as far as is it a good thing, a bad thing? What should we be concerned about with this?
I would say concern that it's telling us something. So when you do what we do is we have to look at not only what we think is attractive, but what the market is telling us. Warren Buffett said, if you sit down at a poker table and you can't find the mark, it's probably you. What does take some worry off is we have the ability here at Trilogy, because we have an open architecture. We get to work with some of the great research houses on Wall Street. This is a common thing among some very, very smart people that they're not getting it right now. And then the final thing, this could be the what we say the debasement of the currency, in that, I mean, could this be the beginning of the end of the reserve currency being the US dollar? And some really smart people I've worked with over the years and some really smart people I've talked to disagree with that thesis, and that if it's not the US dollar, what is it? It's not going to be Bitcoin. It's not going to be gold, because you can't buy and sell commodities with physical gold. It's too expensive to move and you can't break it up. And at the end of the day, it's going to be the US dollar in our lifetime until it's something else. And there's no guarantee it's going to be the US dollar, but there's just no substitute out there right now for it.
Thanks, Mike. Let's talk a little bit about private companies. We had a great question come in
Mhm.
regarding some of the news that we've also seen over the past couple of months around private investments being
Mhm.
eligible within 401(k) plans. So, from a kind of broad perspective, can you talk about Trilogy's stance on private companies and then bringing that down to the retirement space, specifically with kind of the implications of what that means to have that available within 401(k)s?
What a great question, because if you watch 60 Minutes again last night, Larry Fink from BlackRock commented on that. And we've been working on that for a while. Let me give you our view on private companies. It hasn't been a great year for private companies, for the simple fact that the US stock market has done so well. Okay, so we know, again, private companies are not always going to be at the top of that quilt chart. Longer term, it's really interesting when you look at the percentage of investable equities that are public, depending on how you count it. I mean, we're talking taking out the mom and pops doing tax returns in their garage. About 90% of investable opportunities are in fact private. Another reason small cap stocks have such a high percentage of unprofitable companies is because most of the better small cap stocks are privately held. Now, at Trilogy, over the last year, we've brought our clients within our Tactical Plus portfolios the ability to invest in private companies. Now, it's a difficult place to be because the amount of research needed is incredible. Our partner in this area is Makita Capital. Makita looks at 1,500 private companies a year. They filter it down. They do plant trips. They do the operational and the investment due diligence, and they come out to maybe 15, 20 really good investments every year. And we have them because they do that for us, because they have a specialty in that. We actually think that this will garner a lot better return over long periods of time, with an emphasis on long periods of time, because they're not public. There's some liquidity factors that you can't buy and sell them on a daily basis. But in our Tactical Plus portfolios, those are available to our clients. Now, soon going forward, by the end of the year, we're going to be able to offer those to our clients in a standalone sleeve. I won't talk too much about that now. I don't want to overpromise, but those are going to be available for our clients, not just in private companies, but in private credit and private real estate, also with some infrastructure investing.
And are there any
Now,
in Oh, go ahead.
Let me get to the 401k one. It does get me a little worried that these were only available to what we call accredited investors, those with adjusted gross incomes over 200,000 a year, or qualified purchasers, those that have 5 million. These are people that can stand the illiquidity of it, that have other places to go to if they need to pay for college or retirement or any of those other good things you need to if for liquid assets. It's going to be very important to coach up those people to understand that these are long-term investments, and you're not going to be able to get at them unless you're willing to wait quite a bit. Sorry for interrupting.
No, not at all, Mike. I appreciate that. That was going to be my question is kind of around the risks involved
Yeah,
because you mentioned the illiquidity. That's something that people really need to think about if they're going to be taking
absolutely.
advantage of this once it's available widely. So thank you for that. Last thing that we didn't really talk much about, we touched on, but the government shutdown. So that's a big topic as well right now. What does that
A little
mean
bit.
more broadly for the investors? And then how might the government shutdown be reflected in asset prices?
Yeah, that's a really good question. So certainly the government shut down. I know the president's trying to get the military paid this week. I think that's really important. But what we've seen in prior government shutdowns, it usually shades off about zero point 0.2 points of GDP, not 2 points, zero point 0.2 points of GDP per week that the government is shut down. But when you look at it, those things get pent up. And shutdowns, as we've seen, have historically little impact on that year GDP because those things go out and net themselves out. And it doesn't really have that much, believe it or not, of an impact on the markets. Now, if this thing lasts 2, 3 months, we may have a problem there. Also, when we looked in the stock market during the years of government shutdowns, in general, like the last 6 times it's happened, stocks are generally higher 3 months after the government reopens. And you look at the market right now. I'm looking at it. We are again near an all-time high. Um, that's really good. I don't know, I'm kind of cynical when it comes to some things. How essential are some of these government services if in fact the stock market's at an all-time high? The exception was the January 2018 shutdown. That was less about the shutdown and more about the launch of Trump's trade war with China and concerns about labor inflation in that time.
All right. I think let's try and squeeze in one more question. We got 2 minutes.
Sure.
So, Mike, let's talk about artificial intelligence
Yeah.
briefly. What are we thinking about how AI is going to affect the labor market, job loss, et
hmm
cetera? You've seen news about this potentially being a bubble from the financial side. So there's a lot going on in the AI space. Any kind of brief thoughts that you can
Yeah.
share with us on that today?
Yeah, there is a concern about widespread job losses. We actually think when you net it out, now that's important, is to net it out, losses versus gains. It's going to have a temporary impact, and temporary in this case might be a year or two impact on employment levels. What will happen is those directly affected will seek new positions. There may have to be some training involved, as what happens with any new technology. Um, we actually think, and this was an article by both Strategas and one of my Goldman Sachs recently, there's probably an estimated 2.5% of U.S. employment would be at risk to these related job losses. And this is mostly in computer programmers, believing it or not, because there's a lot of computer programming being done by AI. Accountants and auditors may have to be thinned out, legal and administrative assistants, and customer service representatives. I don't know about that because I'm on one, let's just say, ride sharing app, and I'm trying to get rid of an old business account, and it's taken me a month to do that because I can't get anybody to talk to. So we'll see about the customer service representatives.
Yeah, absolutely. Thank you. I think the human connection is always going to continue to
Yeah.
be important. Thank you, Mike, so
Absolutely.
much for sharing today. And to everyone who joined us, thank you very much for your time. We're grateful that you were here. If you have any questions after the call, please reach out to your financial advisor, or you can email investment.team@trilogyfs.com as well. Our next quarterly market commentary call is Monday, January 12th of 2026 at 1:15 p.m. Pacific. We'll see you there.
Thank you.